Dan Goulding on today to have a bit of a chat to us. And Dan's a pretty fascinating dude from my my chats with him over the last few days. He's coming to us from a hut in the mountains of Slovenia. So thank you for getting up in the middle of the night, mate. I'll just give a quick background from what Dan sent through. We won't spend too much time on your background, mate, just because I think whenever I kind of listen to interviews, that's the bit that I tune out for. But I think it's just in terms of what we're going to be discussing. I mean, I've got so much to talk to you about: Neo waves, lunar cycles, magazine covers, all sorts of funky stuff.
Sports, yeah.
Fashion, sports, how they all affect markets. So really looking forward to it. But Dan grew up in raised near Cairns, stockbroker for about 16 years, ABN AMRO, through various iterations of that brand. Wrote a newsletter for some time and still writes a Substack, which I'd highly recommend everyone check out, the Goulding letter, is it?
Yep.
Goulding
letter, yep.
Cool. And occasional articles for FN Arena. So welcome, mate. And I guess the first bit, yeah, no, I appreciate it. And I guess just first bit is, how, you've got some amazing thoughts on the market and a very different way of looking at markets. And I suppose just in terms of the background, I'm interested to find out, how you came to this point where you're looking at all these different perspectives.
Yep. So I've been like a technical analysis since maybe 1999, my first or second year at uni. And I just I'm very passionate. You could also use the word obsessed about the market. Like, I love the market, the philosophy of forecasting. So like, I've gone down every rabbit hole imaginable, Garn, Elliott wave, all esoteric type things. I read a lot of research. So like, I focus on what I think works and what works for me. That's not to say that other things don't work, but I use what works for me. So, I've spent, many, many years reading every textbook I can, from books from the 18th and 19th century, that kind of thing. So like, I'm very well versed in financial history. And I've just come to a world view of how I think the market works, and it's informed by philosophy and science as well. Like, I'm sort of a complexity theorist kind of guy, which is at odds with what academia and most of the mainstream think about financial markets. But it fits in with the way I view markets. So like, I'm not just a technical analyst. I'm a philosopher of financial forecasting is what I really believe I do. And I just think all the pieces of the puzzle I look at sort of all fit nicely into my worldview.
And just to be clear, mate, you're I suppose very almost the opposite from what we're doing on here every morning, in terms of you're looking, maybe month, 3 months, 6 months, 12 months, years ahead. Yeah.
I'm looking at all time frames. Obviously, I live over here, so I don't want to get up at 12 a.m. and trade at 6 a.m. in the morning, sort of thing. So I'm sort of looking. I'm trying to catch a sort of slightly longer moves over, weeks, months, even years kind of thing. But, the beauty of Neo wave is you can have an idea of what might be happening across all time frames. I don't think it works so well in intraday charts. So the shortest time frame I look at is daily, and sometimes I will take daily trades, but I'm more interested in sort of weekly to monthly trades, looking for 5-10% moves. Or bigger, that kind of thing, where I think the risk is minimal. So I'm really looking for where the risk reward profile is heavily skewed in one direction or another, and that's when I'll swing the bat as hard as I can at it. Occasionally I miss, but more often than not I'll connect, and it's going to go for a 4 or a 6, over the fence. So
yeah, and we'll have to touch on. I'm just reading the first paragraph of your latest newsletter, man. It says, regarding the outlook for the next 2 to 3 years, the bear market is highly likely. up to 25%. So no doubt, I'm keen to hear a bit more of that, mate. But so as you said, you've got here, more of a philosopher of financial forecasting. So the first thing, Neowave. This is something that I haven't really spent much time looking at. But do you want to give us a quick overview of that and how you think it kind of ties into, your overall prediction of markets?
Yep. So about 90 years ago, there was an accountant, Ralph Elliott Nelson, who basically wrote 2 books and a series of articles. His view was that the market was fractal and nature self-affine. Now, he didn't use the word fractal, but basically that's what he was saying. And then about 30 years after him, Benoit Mandelbrot come along, the scientist at IBM, and he looked at all financial series, and he's the one that actually coined the word fractal, but basically came to the same conclusion in the 1960s and 70s. And then the 1990s, Edgar Peters, I think it was, formulated the fractal market hypothesis. I think the technical analysis will, that I just think they're well ahead of scientists or the economists in so many areas. And so Elliott Waves it views the market as a fractal in nature, that similar patterns of behavior happen across simultaneous but different time frames. So you have sort of short-term trends, you have medium-term trends, longer-term trends, and they all sort of wash into each other. If you take the view the market is fractal in nature, that means it's not random. Mainstream academia will tell you it's random, but we've known for at least 60 years that it's not random, and that data flatly contradicts the mainstream view of how markets work. But because
when you say that data, what data are you referring to there?
Fat tails, the normal distribution. When you look at the financial data, a lot more crashes and big, extreme events happen than what should happen according to the normal distribution. So you have these fat tails. So extreme events happen more often than they should. And then when you actually get a magnifying glass and look at the fat tails, which as a trader is what you're interested in. You're not looking for this almost approximate random behavior in the middle of the trend. You want to catch the big move. So that, it's the fat tails we're interested in. And if you look at the fat tails, there's power laws driving it, and that's what excites econophysicists. The physicists who came into economics. Because if power laws are driving it, that tells you that the collective is driving the market, or the majority of the volatility in the market cannot come from exogenous factors, cannot come from news. It has to come from within the system itself. The econophysicist Jean-Philippe Bouchard, if I pronounced it correctly, says that 80% of stock market volatility is endogenous in origin. It comes from traders trading against each other, copying each other, mimicking each other, that kind of thing. So it's a completely different view. It's completely anti-mainstream. It's a minority view. But to give you a bit of an idea as well, when the econophysicists first came to economics 20, 30, 40 years ago, they asked to see the economic theory of the time, because, why reinvent the wheel if the theory is good? But when they were given the theory, they thought they were being pranked. They sort of said, do you guys seriously believe this? Because the assumptions of the conventional model, people are rational, or people in the
is this kind of the efficient market hypothesis kind of thing?
Yeah. So the assumptions are unrealistic. People people in the aggregate act rationally. Well, do they? There's a lot of evidence that they don't. So the theory relies on a few good men with unlimited checkbooks and omniscient minds to know what prices should be, and to step in and buy unlimited amounts of shares at the right time to make things right. But who are these demigod investors? I'm not a demigod investor. I like to think I'm pretty good at what I do, but I'm not a demigod investor. I don't know of any demigod investors. Even Warren Buffett, who people like to look up to, he's very early in timing and makes, he makes a lot of money, but he from a timing viewpoint, he's usually far off. So the mainstream efficient markets hypothesis, the assumptions are unrealistic.
So if we believe that, then what's for the average investor trader, what does that mean for me? How can I take advantage of that, or how does that influence my behavior, knowing that?
Yep. Well, I'll probably ignore the news, or don't pay so much attention to the news is the main thing, because if 80% of the volatility in the markets not caused by news, then why focus so much on it? Why listen to economists? Economists use fundamentals to forecast the market. But if fundamentals only account for 20% of the volatility in the market, why focus all your energies on something which matters marginally? That kind of thing. So I think, my view is, if you want to know what the market's going to do, talk to a technical analyst, because they look at the data, they look at the market, they're interested in price, volume, volatility. And if you believe the econophysicists and you look at the market as a fractal, that's what drives the market, or the volatility in the market. And you might say, well, I'm a long-term investor. I don't care about the day-to-day, week-to-week gyrations. Well, okay, fair enough. But if you look at the 1987 stock market crash, I think, the econophysicists would tell you that was endogenous in nature. There was no smoking gun news that drove that. They had a commission to look at the smoking gun. They could not find anything. And the fact is, and I believe it was endogenous in nature. It was, you had this big move up. And like I used to tell my clients back, 15, 20 years ago, when you see something like that, it's generally not driven by news. It's just, people copying each other, fear of missing out, FOMO. So when you see something like that, I can guarantee you about 90% of the time, it's going to retrace the whole move, 90 to 100. It will retrace 90 to 110% of that move very quickly. Because this move was not caused by news, and this drop is not caused by news. It's just, this is fear of missing out, and this is revulsion. So
I think anyone that's kind of jumped on these calls and have gone through that, obviously just on a day-by-day basis in terms of, CPI yesterday, RBA, etc. We 100% would agree with that premise. I mean, CPI yesterday is a good example where in the first 10, 15 minutes, we knew where the market was going to finish for the day. Sorry, not yesterday. When was it? Wednesday. Same with RBA. The theory that a lot of people throw that, you've got to wait for the announcement to see where the inflation comes in at or what the RBA is going to do. I mean, the data just does not support that. I mean, it's the trend for the day is done in the first 10 or 15 minutes. There is something I want to loop back to a bit later based on what you've said, where there has been, the odd time where it is unexpected and the market does react in a way that we wouldn't expect from the data. It's rare, but it does happen. So a bit later, I'd like to touch on, I think you made a comment in what you sent through to me around you basically don't kind of trust those moves. So
exactly, yep.
Very interesting. Yep.
Can I butt in and ask a few questions there, Daniel?
Yeah.
Was this born out of, you mentioned you were a stockbroker, and I guess like being in that space a little bit, I've seen how much is fundamental analysis. Was this born out of frustration from trying fundamental analysis of companies?
Like I sort of do use fundamentals a bit. Like I really do like the Warren Buffett, companies, high return on equity, low debt, competitive advantage. So I sort of do that. But I think in general, like, the fundamentals always look best at the top and they always look the worst at the bottom, kind of thing. So, in price I trust, the price and the volume are going to give you a good idea of what, the market thinks, and that's how you're going to make your money, kind of thing. Because, fundamentals, it's all a narrative. You know, it could be true, it may not be true. You just never know. But you know, price and volume, they're going to, you know, give you the answer, you know, as to what the market thinks, and that's how you get paid. Yeah, that's my view. So I think
Right.
you know, and maybe a bit of a contrarian streak in me as well, sort of, you know, made me love it more. But you know, if I had one choice, it'd be just technical, and it's just price, volume, and volatility. It would be the only three things I look at. Internal, you know, some of the other indicators I look at as well. But you know, some technical analysis will sort of say they love it when the technicals and the fundamentals align. But when the fundamentals align, you're kind of halfway through the move already. You know,
Right. Yeah.
You know, when you look at major tops and bottoms, like at a major top, the news is, it can't get any better, and retail people buy because it's like the news. Well, you know, the economy is doing well, it has to go up. But that's when the smart money's selling, because they know it's as good as it gets. And you know, so when I look at the news, I'm not looking really at the news. I'm looking at the reaction to the news. Is the, you know, if good news is coming out, is the market going up? If it's going up, that tells you probably halfway through the move, so you can still expect a bit more to come. But if good news comes out and the market doesn't go up, you're near a top. You know, that kind of thing. So like, I am interested in the news, but the reaction to the news, not the news itself. Like, and I think the other thing with fundamentals too is, you know, to make money from it, you sort of have to be better than the crowd, kind of thing. Whereas, you know, technical analysis, you're relying on the crowd to you know, to have an opinion. And I don't think I'm some kind of fundamental guru, but I think I can read what the crowd thinks of something and take advantage of that.
Mm-hmm. And was there any early technical analysis tools that you tried out that didn't work? That
I've looked at everything. Like I you know, when you get a simple technical analysis book, I think a lot of it's just garbage, to be honest. You know, like the price patterns, even though Elliott Wave sort of involves price patterns, you know, I just think when you're looking at a chart, just seeing a pattern like a triangle doesn't mean it's a triangle. Like, you need to look at volume and a few other things to confirm that's actually a triangle. So like, I don't quite like a lot of the basic theory that comes out. Gann is something I'm really interested in, but you know, it's very esoteric and very mysterious, and I follow equinoxes and solstices, you know, I think, and Garniversaries, you know, Garniversaries, because I think, you know, as to why they are important, I don't know. I think it's, you know, the collective unconscious, or, you know, the market has a memory, something like that. So, you know, Garn is something I think could work for people, but I think, you know, it doesn't work for me, or I don't have the time to really go down that rabbit hole. So, yeah, so in technical analysis, like I said, I think, you know, I wouldn't trust the simple textbooks so much in terms of the patterns. You know, it's like looking at cloud, you know, looking for patterns in clouds in the sky. You know, you can see tigers and elephants and that kind of thing. You can see all sorts of things in the charts, but you really need volume and volatility and all those other things to confirm that what you think it is really what it is. And I think, you know, maybe not so much in Australia, but in America, you know, your bigger operators can kind of push prices around to make patterns appear, you know, to sort of convince people it's going to do this when it's going to do something else, kind of thing. So even though I'm a technical analysis, like I said, you know, I think some of the theory outdated, or, you know, is not the best. Yeah.
And Matt, I might, I'm keen to get, if you want to, in a minute, share your screen there, if you've got some examples of this that we can kind of quickly talk through. But before we do, just on the last point that I was making. So I wanted to give you a bit of a test of the theory potentially, where, okay, so just back to that previous example where, you know, I'm looking at data here for the last 5 years, Australian CPI, okay, and there's one particular indicator that we look at very early on, and it predicts the end of day outcome 90 plus of the time. So there's one in the last 50. There's been one day that it didn't predict correctly, and that was a negative reaction when we were expecting it to finish positive. So do you have any thoughts on, going back to your comment in here around, well, I forget the actual words that you use, but essentially, you don't completely trust it if it, it doesn't follow the trend or whatnot. How would you think of that in terms of like what may happen next, or etc.?
So I really believe that like moves that begin on the heels of news, so like news inspired moves are suspect. 9 out of 10 times they're a false move. And so if you get like a sell-off on an unexpected CPI announcement, it's a buying opportunity. Maybe not necessarily intraday or the next day, but it's an opportunity to buy because major tops and bottoms don't occur because of news; they occur because of sentiment. And smart money is big money. They can't just turn on a dime, kind of thing. So anything, like I said, any move that begins because of news, I'm looking to fade it very quickly. Especially if I think the trends, if I believe the trend's up and there's a sell-off because of CPI, I'll be looking to buy that, ears pinned back as much as I could.
Okay, I'm going to share the screen, mate, and see if you pass the test there.
Okay.
If you can, let's see if we can do this. Share. Oh, one sec. It's not very exciting for the people at home, but I think it's very very interesting if I can somehow manage to pull this up. Okay, so this was the date here, right? So about 2 or 3 days later, we went on to a 2,000 point run. So I think you're spot on, mate. That was, as I said, out of 50 occurrences, this was the one that stood out as a real outlier. And as I said, I think it was 2 or 3 days later that we were on the run and at bottom. So well done, mate. Very good.
Glad I passed the test.
Without notice. But yeah, is there anything in terms of that you got there that you want to share? Like, I'm just looking at some of your waves that you've got in the newsletter there. If you want to bring them up.
Screen.
I guess my only, comment on what you're doing, and I think Bo actually went through some of your newsletter and found that you're spot on the mark quite a lot of the time when you look back. But I guess my natural, hesitation or skepticism comes with this kind of stuff, that there's obviously a lot of options of where the market can go. So I think a lot of guys will kind of make draw these lines and then just be basically continually updating them depending on where the market's going. And I think that's maybe just for me, but for others, that's probably where the skepticism comes in a lot of this.
I think that's a really valid criticism of Elliott wave, conventional Elliott wave. They usually have multiple counts most of the time, all the time. And it seems like they can, in hindsight, everything was forecastable kind of thing. Whereas if you look at my work, I would say most of the time I only have one count. And I use that count until it stops working. And then if it does stop working, usually I only need to make a minor revision to it, kind of thing. Now, at the moment, it is I've got 3 counts, so that sort of, you might say that makes a fool of me, but it's not, because I try to, and I'm trying to do that over time with my newsletter. Like, I usually try and give probabilities, because while I'm forecasting, I'm forecasting more from a risk management viewpoint, because, with trading, sometimes you can't sort of forecast what's going to happen, but you can kind of know what can't happen.
Yeah.
And then you can trade based on that. And if what can't happen happens, then your interpretation's wrong and you need to get out immediately, kind of thing.
Yeah,
So
that's pretty much what we do on a daily basis, mate. Is exactly what you've said with the data. We try and have our hypothesis of what will happen, and then you want to know as quickly as possible that you're wrong, so you can throw it out the window.
Yeah. So that's what I try and do. Like, I try and give probabilities, and I try and give price targets and time frames and that kind of thing as I see it. Sometimes I have no idea, and I'm happy to admit that. It's rare, but there are times in my newsletter where I might, rather than a daily chart, I might put a monthly chart, because I don't know. But there are other times when I'm very confident. At the moment, I am quite confident, and I've said that in my newsletter. Like, I believe the green scenario is happening. Like, in the newsletter, which I'll be writing in the next few hours. Like, 2 weeks ago, I said it was 75% chance of it. So even though there's multiple counts, I've given odds that 2 weeks ago I thought it was a 75% chance that green scenario is happening, and the other 25% was the orange and the red. And then last week I sort of said the odds of the green have increased, the odds of the orange have increased, and the odds of the red have decreased. And now, today when I write it, I'm going to say the red scenario is a 5% chance. Like, I think it's 0, but I'm not dogmatic. Like, I'm not dogmatic about things. And it's just, there is one concern I have, that I'm not going to say it can't happen. It's impossible.
So just for people that might just be listening, so we obviously rounded it bottom to about 7,800. So you've got a scenario where it rallies to what, say 8,400,
83, 84, maybe.
In late April or something like that.
Last week of April, early May. And that's just based on sort of the interpretation that that the action is a triangle. And I think that, and this is one of the things I'd sort of like, I think your audience can take away is, Neowave's all about the psychological trend. We're trying to quantify price action. So we're not so much concerned about the price trend. Series of higher highs and higher lows would be defined as an uptrend. I'm more worried about the psychological uptrend. It's more about what the behavior of prices.
So can you give me an example? Can you give me, like, how would we discover that it's a psychological uptrend then?
Yep. So if you look at the chart here, you can see that this green box here is the rally into this December high. And then what you saw thereafter was a very quick decline, which retraced the whole rally in about half the time in a less complicated manner. So less complicated, I mean more of a straight line. It doesn't look so messy. And that tells you the psychological trend is down, because the largest, fastest moves happen in the direction of the psychological trend. And the psychological trend is where the greatest risk lies. So, it was clear as day. It did it in half the time. So it was clearly telling you that the psychological trend was down. Now, sometimes what happens after that, it can be a directional manner that the trend happens, or it can be more of a sideways manner. And at the moment, it's happening in more of a sideways manner. So even though, after that decline, the market was able to move back to new highs, you would notice that compared to that decline, the rally is very messy. It's very complicated. It took a lot more time. So even though it was able to manage a new high, you still knew that the psychological trend was down, and that there was going to be a down move of some degree, at least it would retrace at a minimum 90% of the time. It would trace at least 61.8% of that rally, and usually a lot more kind of thing. So I think that's the greatest takeaway is, the psychological trend is where the risk reward profile is skewed. Sometimes the pattern works in the sideways manner, so that, if you're short, you may get stopped out. But, as a trader, you're sort of looking for asymmetric trades. You want, something where, the odds are, 10 to 1, 4 to 1, something like that.
Yep, sure.
Yeah, and the other sort of thing to take away, I think, from this is as well is if a downtrend is happening in a sideways manner, that tells you that the power of the trend, and that gives implications for the future trend, and that's why I think there is one more high to come. I don't know how high it's going to go. Somewhere between 8.6 to 8.9. I don't think it'll get to 9,000, but somewhere in there, it's going to happen.
Can I just I do want to get to how you are forecasting that high, but if I can just challenge you on one thing that you said. So looking at this chart, right, and you obviously said this last kind of move to new highs, was complicated or whatnot, but to me, all that shows is the old adage, up by the escalator, down by the lift. So I guess I'm keen to hear a response of, like, to me, that if we didn't have that last fall, I reckon you could tack that onto any part of a multi-year uptrend, and it just keep going higher, because that's generally how markets react. They fall quickly and then they kind of slowly make their way up. Whereas you're saying, I guess my point, I guess, is that it's easy in hindsight to say that, but I think if you cut it off, for me, for an uneducated person, if you cut that off at the start of February, it would look like 100 other times that the market's kind of just drifted higher, and it's just kept drifting.
Yep. I agree a little, but I also disagree, because I think when you sort of find periods where the psychological trend is up, like they move up, and I'll show you a chart now. Which one should I look at? 30 months. Okay, so everyone can see this chart? Yep, okay. So this gives you a really good idea, and this will speak to my long-term view of the market. So if you look at sort of the price action from 1973 to the peak in 1987, you can clearly see that the largest, fastest moves, were to the upside. There's no doubt. The downward moves were minor, slower kind of thing, and then from 1987 onwards, it's the opposite. So the way I look at this is the move from 1972 to 1987 was a trending move, and that the price action since 1987 is a counter trend move. Counter trend. Now, the fact that it's being pulled up tells you that at some point in the future there is going to be a huge bull market. So, and when that happens, you're not going to get that kind of phenomena that you sort of mentioned. That the fastest moves will happen to the upside, just like it was from 19. I believe it started from around 1974 for various reasons, but you look at that chart, I think it does show if when the trend's up, that's where the largest, fastest moves. They should be going in that direction. If they're not, then your interpretation's wrong. So
how are you consolidating that with your view that in the next few years we're going to fall 25%, but then you're also saying that you really do think there's going to be a really large bull rally
Yep.
over the next
So
decade or?
Yep. Yeah. So the view that there's going to be a 24% decline is just sort of based on this behavior in this period here, where it's very clear there has to be at least one, probably only one more downward move, and it should relate to the previous big moves down. Now, I believe that the downward move, and the way I calculated, it's a trade secret, but I'll give it out. But I believe the next sort of bear market is going to be 61.8% of this decline, which was the COVID crash. So that's where I come up. It's just based on price patterns. I could be wrong, but when I look at the chart, I know there's at least one more big decline, and because of the view that there is a huge rally out there, it has to. That's why the market's being pulled up, because that future bull market, it's this action in here. I have to use my mouse, not my finger. The power is so great. All this, it's just pulling the counter trend action up and up, but there still has to be one downward move. And because we're getting closer and closer to that kickoff point, that downward move should be minor compared to the 2007 GFC. Like when a market's about to kick off, momentum to the downside should be waning. And that's why I think the decline will only be at 24%. It could be a bit more, 25, 26, 27, something like that. But momentum should be waning. So I'm pretty confident we're getting a drop of around that magnitude. And if it's only around that magnitude, that clearly tells you the momentum to the downside is waning. Because the 2007 crash, if I remember correctly, was probably about 50%, maybe just over 50%. And I think the COVID crash might have been around 35. I've probably got the figures wrong. It's 12:30. Well, it's almost 1 a.m. here. And it's been a time since I looked at the figures, but I think I'm probably pretty close to being correct. So that's where that figure comes from. It's just from the pattern, the view that when you look at the chart as well, like there's no when a new trend starts, it must retrace the prior decline in a less complicated and quicker manner. And you may say it is happening on that chart, but when I look at other charts, it's not. So, we're still counter trending, but the future bull market's so strong, it's pulling it up, and that's telling you that the next bull market will be at least as big as the bull market that went into 1987, but more likely it'll be 160% the size of that. So that gives you a figure of about 120,000 points on the ASX 200 by about 2050, 2060.
Right.
Which sounds crazy, but compounding it's not that crazy. And I believe that kicks off in the next few years. So I think this decline, the 24% decline, won't actually be the end of the bear market, but it'll be the low, because if I'm right and this future bull market's out there, the low of the bear market will be a much higher low than the actual low of the pattern. The low of the pattern in a scary phase, just like the 1987 crash, there was a bit of a triangle. You can sort of see here, the low of the completion of this pattern here is actually in here somewhere. So it wasn't the actual low, which is here, it was over here. And that was sort of telling you that there was some strength, like when a pattern completes at a higher low, it's telling you there's some power to the next move kind of thing. And then you look at this whole move here and this whole move here, it's telling you there's something big out there. But there has to be a downward move. And I think pessimism has to be a lot higher for it to start. So, something in the next 1 to 2 years, whether it's inflation going through the roof, wars, something has to happen. And I think Trump too, even though a lot of people like him, there's also a lot of other countries that don't like him. So I think, and I think too, Trump has a big job ahead of him. The debt they have is phenomenal. To right the economy, to sort of get the debt on track, he really has to he really has to bludgeon spending, and doing that will cause a recession. So I think
that could be a catalyst.
Yeah, and he's going to try and cause it early on, so that in his third and fourth year as president, the economy is sort of back on track, kind of thing. So that kind of aligns with it as well. So bad news? Yeah.
Fascinating stuff, mate. I want to move on to the funky stuff next. Yep. But does anyone have any questions on the Neowave, Elliott Wave stuff for Dan?
I have one question. When you're with the Elliott Wave, and then what you were talking about before, with the fractal price, doesn't that mean that it would work on lower time frames as well? So like it would on the higher, because if price is fractal?
It does, but I think price may not necessarily be like 100% accurate in terms of identifying or signifying the collective mood of participants. Just think of Fat Finger, for example. The 2011 flash crash. Exactly what caused that, who knows? But the official explanations of Fat Finger. So one guy accidentally selling 10 times what he should have, could sort of slant the charts a bit. And I think the risk of that on intraday charts is a lot higher.
So it's like the day-to-day, it's just there could be too much intraday volatility, whereas you do the higher time frame, so you're kind of just catching the move instead of dealing with that intraday stuff.
Exactly. Like that's what really separates Elliott Wave from Neowave. Elliott Wavers will start from they use intraday charts, and they'll try and count everything on the intraday and work upwards, whereas Neowave is the other way around. You start from the longest time frames, and if the counts on the lower time frames don't match, they need to match, and then you only become interested in the lower time frames when there's something big happening on higher time frames. So that's why I don't really look at the intraday charts from a Neowave viewpoint. When I look at an intraday chart, I'm looking for gaps. I'm looking to see, which direction the market gaps. Does it close the gap? How quickly does it close the gap? And that will actually give me some idea as to the pattern, in terms of the price patterns that I follow. I believe, the gaps and how they're closed, and, they should align with the pattern that you're looking at, or whether you think the market's bullish or not, kind of thing. So I do look at intraday charts. I think it's just a waste of time. I think you could do it, but and Elliott Wave would tell you that's the way to go, but I disagree. I'm Neowave, and we're excommunicated from the Elliott Wave camp. They don't like us. We're the dark side.
Right.
So there's just too much noise on that time frame, you think?
I think so. I really do. I think if something looks really clear, then by all means, I think you can easily trade it. But I just, I think you can, if you've got a pretty good idea what's happening on the daily and weekly, then I think you could use the intraday. But I think you need to, know what the trend is on those higher time frames to be able to use the intraday one effectively. That's what I think anyway.
Yeah, that makes
sense. So mate, that for an average punter like me, that's initially skeptical of the Neowave stuff, wait till we get to lunar eclipses and and lunar phases. So tell us why we should be paying attention, mate, to these in terms of market movements.
Yep. Well, if you subscribe to mainstream, the conventional view, it's just it's just total bogus. Man's just a machine, calculator, perfectly rational, no emotions whatsoever. But who really believes that? And if you look at the evidence coming out of neuroscience in the last few years, a psychologist will tell you that the majority of decisions everyone makes, are driven by emotions. And so you'd have to think that emotions must play at least some part in, whether to buy or sell shares. And just actually recently, I think 1.5 years ago, there was a paper where the scientists concluded that the seasons were probably or maybe a fundamental factor in the variation of how people actually think, not just feel, but how they think. So, and technical analysis have been saying this for over 100 years, that there's seasonality in the markets, and obviously mainstream, because, it can't happen according to the model. Like, if people knew about it, it should be traded, it should be competed out of the market. But, I follow seasonality religiously.
So when you say seasonality, are you talking specifically the kind of lunar cycles?
Yeah, the lunar and the semi-annual cycle, where you tend to find bottoms in the market around March and September, October, and I think when you look at the lunar phases, the semi-annual cycle in stocks, it's all to do with geomagnetism, and people will call me superstitious for that. But, the Federal Reserve released a paper about maybe in 2003 saying that when there's geomagnetic storms, markets go down, or, it sort of increases risk aversion. And it's statistically significant. And if you ever actually, there's a really good book by a physicist, Stephen Pitts. I can't remember the year that he wrote it, some time ago. And he sort of, he gives many charts. He's a mathematician. And, his view is that, geomagnetic activities inversely correlate with risk appetite. So when geomagnetic activity is high, people tend to be more nervous. And, geomagnetic activity is highest at the equinoxes and lowest at the solstices, which completely is in line with the seasonal cycle in stocks. And it's one of the reasons why I thought, just 2 weeks ago, I was telling my readers, March 14 was a lunar eclipse full moon, and March 20 was the equinox. So I said, look, based on history, you should be looking to buy. If you look at the last 20.
So sorry, mate, just to cut in. So in that particular example, was that, when you say looking to buy, was that because we were trending down, or is it just like buy, like whether we were trending up or down, it was a buy? You think that it's people are more, partial to buy then?
Yeah, I just like looking at seasonality and isolation. I am interested in buying things in March if there's a pronounced downtrend going into that period. It's not necessarily to say that March will be the final bottom, but it's usually, in the worst case scenario, it's a multi-week to multi-month bottom. It may be broken eventually, but it's going to hold for quite some time.
Okay. So sorry, just to put that another way, if the market was trending up in March, would you have said buy or no?
That to me would sort of suggest the trends. If the market's going up during a period where it should be weak, that's giving you a pretty good clue that the trend's pretty strong.
Okay. Yep.
Kind of thing. So that's
so March is typically a week, like it's week leading into that kind of lunar activity, and then bottoms. That's the general shape.
General shape, like exactly. If you look at the 5 biggest declines in the ASX 200 since 2000, 3 of them bottomed in March. So it could be a coincidence, but when you look at other things like suicides and admissions to hospital because of depression, you see the same cycle. So there's something about the equinoxes that's causing people to be anxious, kind of thing. And solstices is when geomagnetic activity is at its lowest point. Tend to sort of be when markets top, kind of thing. So and that's one of the reasons why I think April's, statistically, April is phenomenal. Like it's a gangbuster month. I just
we touched on that earlier, but I think might have been in your last newsletter. But yeah, so April's by far the most bullish month historically.
Yeah, by far, and I purely think it's to do with the dissipation of geomagnetic activity, like into the equinox when it's at highest, and it just really sharply falls off the geomagnetic activity, and that sort of supercharges any rally, kind of thing,
Mhm.
and that's why I think it's so powerful. If you look at an average sort of cycle for the ASX 200, you sort of get your tops. I think July, August, and then you have a bit of a sell-off, September, October, the other sort of period, when the equinox happens kind of thing. And then like the December rally. And again, I think, the rally into December, it's partly to do with optimism around, Christmas and that kind of thing, but it's also to do with the solstice. Geomagnetic activities dropping off. It's going to supercharge whatever uptrends in place kind of thing. So, with
have you got anything on the screen that you can show us, mate? Did you end up finding that indicator that we were talking about,
No,
or do you have anything on the specifically on the lunar stuff?
Yeah, not particularly, but it's sort of not particularly. It's sort of this one here is when basically the full the end of this blue line here. If you can see that, it's sort of when the full moons are. And, I'm really interested in the full moon around the equinox. So the equinox would have happened just a few days later. So from a seasonal viewpoint, you will have been very interested in buying it here. And again, if you look 2 years ago into 2003, let's go back, when the bank in the US was collapsing, World Bank or whatever it's called in Silicon Valley. If it works, here we go. So yeah, full moon here.
I think we're on the mate. We're just stuck on the your PowerPoint. Oh, your Excel there. You might have just shared that.
I need to share it. Yeah, yep. Okay, give me 1 second.
Yep.
Okay.
Yep.
What's this sharing stuff? Share. Okay, so this is going back to 2023.
Oh, yeah.
I think it was World Bank was the name of the bank in Silicon Valley that failed. And then around that time, Credit Suisse sort of announced significant lapses in internal risk protocols. So you can see here. Okay, so it wasn't quite, the full moon sort of was a little bit later, but, the equinox would have been, it pretty much bottomed on the equinox or a day after kind of thing. So, like I said, I think, the equinox is really something to pay attention to, especially if the market's been dropping heavily into it. If you look again, at the GFC, I'll just quickly go back. Hopefully it doesn't take too long.
If you click down the bottom there's a little calendar next to time frame. Yeah, right there, the little calendar.
Yep. Okay. Yep. Oh, sweet. Okay.
And you can just enter 2008. Yep. Just put it on the keyboard there. Yep. There we go.
Nope. Okay. Did I do something wrong?
Just put it on the keyboard, I'd say. Click where it says 2025 there on the text and just put 2008. No.
Might. Will it go back that?
Daily should.
That far. Yeah.
Just try and enter it on the keyboard. Yeah, cool.
Is it the month next? I guess. Yeah.
Yep.
Yep. Okay.
Bingo.
And just click go to. Yeah.
Hey. There we go.
Yep.
Excellent.
Okay. Perfect. Yeah. So this is sort of the first stages of the GFC kicking off. You can see again, the low happened 17th of March. So it would have been 3-4 days before the equinox, and then the full moon happened here. So, just a few days before, a few trading days before the full moon kind of again. So, even though the trend was powerfully down, you got essentially a 20% move over 2 months. So like, it's just a really good time to be paying attention. it doesn't work all the time, but it's just something I think you should be aware of, as an investor, and if you look at all the studies on lunar phases, I think the majority of them says it is statistically significant. So there is something there. Like mainstream denies it because it can't happen according to their model, but their model is so unrealistic, and to me, if you can make money from it, I'm interested if it makes money. I'm a dark, you call me superstitious, fair enough, but I look at the data. If it doesn't work, it's a heap of junk, but it works, so.
And I guess that's, bring back to what the kind of things that we look at. I say that a lot as well, in terms of like, I'm not sure why this works, but it seems to. And can you just repeat, I think it was when we were talking the other day, we were talking about, was it Renaissance or one of those guys? And you made the comment around, can you just repeat what you were saying the other day?
Yeah, so basically the most data-dependent guys on Earth, and it was a news article talking to one of their quants. I think one might have been the head quant. He was basically saying their most successful signals or algorithm, are the most non-intuitive. And the reason that is because if it makes sense, people would have researched it and exploited it so that the edge no longer exists. So they found that their most profitable signals are the ones that don't make sense to most people, kind of thing.
Amazing. Yeah,
and it was actually the head quant trader who basically said that it's actually Main Street, academia who are superstitious because they refuse to look at the evidence because because they start from axiomatic truths, like the news drives prices. It's automatically assumed in the model. So it can't be challenged. So they're the ones that, when you present evidence to them, well, they just say, well, it can't be. That's their argument. It can't be. They don't look at the evidence. So, if anyone's guilty of superstition in markets, it's, is it me, the lunar guy, who looks at the data and all the studies? I think, you could easily say at least 70 to 90% of all the studies says there's something happening there, So I don't, I'm a data guy, I think, and go back to what you were saying earlier. One of the questions before was, about technical analysis. I think, it should really be data driven, kind of thing, like, price patterns, if frozen there, maybe.
No, you're right. We can hear you.
Yeah. So basically, like I said, I'm just a data guy. Like, if it works, it works. As a trader, I don't care why it works, but I also
you're agnostic.
Yeah. But as a philosopher of financial forecasting, I am actually interested in mechanisms, kind of thing. So it depends if you're wearing your trading hat or not.
And I suppose that's the purpose of having these chats for my guys that are on here, is terms of I'd love these guys to have different tools in their toolkit, in terms of if this is something that you can have in the back of your minds, obviously being data dependent, but every day I suppose we're looking to make the best decision possible in terms of a trading plan based on a hell of a lot of incomplete information. So something like this is very worthwhile, I think, mate. Well, I know you've got here what was it, magazine covers and sports, but I'm cognizant that you're you're probably ready to go to bed. But one thing that I wanted to just touch on before we wrap up is the last hour index, and this is probably why you kind of jumped out at me initially, in terms of that I look at something very similar, and I look at the last 90 minutes, but similar thing in terms of, I've got a theory that the moves into the last, hour and a half in our market, predict what's going to occur in other markets to some degree, and also our open the next day. So can you just, I know, don't give away trade secrets, but what's the kind of theory with that?
Yep. I'm happy to give away trade secrets on this. I'll just share my Excel spreadsheet. So share screen. So everyone can see that, I'm hoping.
Yep.
Okay. Yeah. So like with the last hour index, like I sort of don't obviously use it to sort of anticipate what other markets may do. I'm just looking purely, at the ASX 200. I like to use it to try and affirm my interpretations of what's happening with price behavior. It's less like a checks and balances kind of thing. I look at this and internals and a few other things. This sort of, if I have no idea what's happening, then I'll look at this to give me some idea of what I should be thinking about. But most of the time, I'm using this to sort of work out whether I'm sort of in the ballpark of being right or not. So here is the last hour index using the equal weight ASX 200 with the close, and you can kind of see that it kind of really anticipated very well that decline, that happened recently. And then I'll just.
Are you processing this data yourself? Is this like extracted and processed?
Yeah, I just sort of get the data from Iris and I just plug it into the spreadsheet myself. Like I think, obviously I could probably automate it, but I like to see, there's an argument for doing it yourself, plugging the figures in so you get a feel for the data yourself kind of thing. So I just do it every day. I do 4 different indices. So this is the ASX with, equal weight 200. And then, where are we? Can everyone see this screen? I'm having a look. Yeah, okay. So this is, I do 4 different versions of it. So this is just the benchmark ASX 200 with the close and without the close. Now, this is quite interesting because it's sort of giving you a very different view. It's telling you something different, because both those last hour indices using, the ASX 200, they're at pretty much all-time highs. And so the way I reconcile that is that, major tops are a process. And generally, when you look at the data, the majority of stocks, at least 50%, peak well before the peak in the actual ASX 200 itself. Only a handful of stocks actually peak on the day the ASX 200 does. At least 30% of stocks are in official bear markets at the top, kind of thing. So what I think, when you look at this version and you look at the equal weight version is telling you there are problems, and what this is telling you is that big money or traders, sort of sophisticated traders, they're moving down the risk spectrum. They're selling the riskier companies, and moving into more liquid names, so the ASX 200, like the top 8 companies make up 33%, of the index, the banks and BHP and CSL. So this is telling me that, deep pockets are selling riskier stuff and they're moving to more safe stuff. So this is, what you'd expect going into a top. It doesn't mean it has to be a top. It could be more of a deep, long sideways consolidation. But this is what you see. And what I would expect to see is that this index, using the benchmark ASX 200, I would expect it to diverge before the final peak in the ASX 200. So when I reconcile everything, there's big problems, but we're still probably many months. We're probably, months away from the final peak in the ASX 200. So that's why when I put an 80% chance on the green scenario for the NEO wave being correct, this is one of the indicators I was looking at, saying, well, if a crash was happening, this chart clearly contradicts the idea that a crash is happening. This says there has to be one more high. It doesn't have.
So can you just explain that? Like how do I look at this chart, and like what's driving that last hour indicator behind the scenes for one, and how do you reconcile that in terms of that there's no prospect of a crash?
Yeah. So basically, for me, like the last hour is, the most liquid part of the day. So it's when, the big money really trades. Obviously they trade all through the day, but they're really active in that last hour. And deep pockets have to move early. They have that much money, they can't turn on a dime like the retail investor. If I get bearish, I can sell everything in a day and be done with it. But if you're managing billions of dollars and you hold a lot of positions in small cap stocks, you can't just push the sell button and sell everything. You'll crunch the price 20%. You're competing against yourself. So they really have to be early and just slowly sell into strength. And that's why things like the last area indicator and internals, they give you, they're a really good hint.
But what is the data behind this? Is it what is that showing? Is it that it's rallying into close, or it's selling into close, or what is that actual
it's rallying,
data?
It's rallying in the last hour into close. So you would have to think, if a crash was already happening or a bear market was imminent, like days, weeks away, 90% of the time, 95% of the time, you would expect, smart money's been selling for quite some time. So you would have expected the last hour indices to have been trending down for quite some time. And it's my view. It's just my view, not necessarily correct, but the greater the lead and the greater the divergence between the last hour index and the ASX 200, the more significant the inflection point in the market. So if you sort of look this period back here, there was sort of weeks to months before this rally kicked off, kind of thing. So I was telling you that this rally was probably going to be a pretty significant kind of rally. So if you only get a divergence of a few days, that tends to suggest the pullback's a minor pullback. But if the last hour index has been trending down for weeks and months before the peak in the ASX 200, that's sort of telling you that it's a major inflection point. Doesn't necessarily mean it has to go down. It could go sideways, but it's a major inflection point. And in my experience, 3/4 of the time when the last hour index is telling you there's trouble ahead, it goes down. 25% of the time, it resolves in a sideways manner. And it's the same with the internals. If they're warning of trouble, 3/4 of the time, there's going to be a meaningful downward reset in price. 25% of the time, it resolves sideways. The correction happens in time, not price. It happens through rotation from small caps to big caps, and then the money rotates back into small caps, and then things fly off again. So, So this.
So is it more the trend, more the trend of that line than anything?
It's the trend, but it's also how it's moving and how quickly, kind of thing, as well. So. Yeah.
So that period, for instance, that you've got here, early August, where kind of the pace of the trend higher really picked up, and we obviously had that sell-off in the ASX 200. Is that what do you kind of read into that?
Which sort of sell-off? Sorry, just
August 24, so just above 3rd of August 24. Yep. So if you look, there's that real kind of acceleration on the orange line.
Yep.
So over the right, if you've got your cursor there.
Yeah. Yep. So it's just interesting when you look at this behavior here. This was sort of giving you the all clear signal, so that telling you that this dip was to be bought. If you look at sort of the equal weight index, what it was doing, it was quite a bit more bearish. So it gave you a lot more of a lead time going into that, but even then it still gave you a buy signal. So I try and look at both the equal weight and the ASX 200 to sort of reconcile a view. Most of the time they agree with each other, but at times they kind of disagree. So it's, for me, it's about trying to reconcile them. And obviously I'm probably heavily biased in terms of what I think is happening in my interpretation of price behavior. So to some degree, I'm biased by that. But, even if I wasn't aware of what price was doing, I'd still probably come to the same conclusion that this chart here is telling me there's trouble ahead. You know, like it's the last few weeks it started to move back down. So deep pockets have been selling the riskier stuff and moving into the safer stuff. That's clear as day. It's just the question.
That's what you're seeing from that at the moment?
Yeah, from this chart, this is the equal weight. So, you can see the ASX 200's at all time. The last hour index for the ASX 200, the benchmark's at all time highs. But this one, the equal weight, it is way off its highs. So that's telling you that the money's moving into the safer stuff. So they're sort of concerned. They're not. The fact that the last area index for the ASX 200 is at all time highs means that they don't think a huge bear market's about to kick off, but they're still concerned. And I expect that over the next few months, you'll start to see that concern register in the last area index for the ASX 200 benchmark. I'm quite sure that's going to happen. And when I see it happen, that's going to be an affirmation of my view of wave structure. That there is a bear market of around 24% happening. So,
can I just confirm? So your short-term trend is slowly grinding up, and you think this chart will essentially start pinning new lows as it moves up, which will be part of the signal that this is going to roll over into that.
Yeah, I expect this one to hit new lows soon. Not necessarily the next day, a few days or weeks, because I think the orange line will probably go sideways for a while during that period.
Yeah.
But I would expect it to hit lower lows sort of sooner rather than later, and then I would eventually expect to see the ASX 200, the benchmark last area index do the same thing. If you just sort of, you shouldn't do it this way, but if you did, you can sort of see, the orange line sort of at, what's that, 12-month lows, kind of thing. ASX 200 should be a little bit lower, but it's sort of caught up to it. That's why the decline was so large recently. It did sort of catch up to it, but it's still warning it should be lower, kind of thing. So, so I would expect this line to be hitting lower lows, not in the next days or weeks, but I think a few months from now, I think it'll be pretty clearly moving lower.
Okay. And that's because the professionals are spotting this a bit like you and moving out. And
for whatever, that have multiple reasons. It could be idiosyncratic reasons that have nothing to do with the economy. Maybe that hedge, maybe some billionaire has tax, has to pay tax and just needs to sell something. But, but usually, most of the time it's not idiosyncratic reasons. It's their risk. That orange line's telling you risk aversion is on the increase. And that's the other sort of probably key takeaway from today is, if you look at just the ASX 200, the benchmark, it's a red herring at tops and bottoms. And that's why economists who, it's funny that they use the ASX 200 when they're trying to forecast the economy, but they use that, not realizing that at tops and bottoms, it's kind of giving you a false signal. Because as I mentioned, most of the stocks have already peaked well before the ASX 200. And the only reason the ASX 200 managed to rally to that final high is because of strength in the safe names. And if the safe liquid names are going up and the risky stuff's going down, the newspaper will say it's a risk on market. Market's hitting new highs. It's risk on, but the majority of stocks are going down. So that's why I look at this in the internals as well. The internals are sort of giving a similar message to the last area index that there should be at least one more high out there to come. So so and that sort of agrees with my wave structure from a new wave viewpoint. I think there has to be at least one more, preferably only one. There could be two, but major price patterns don't begin from the absolute peak. They'll begin from a lower high. So that's why I think this next rally, when it happens, will be the peak of the rally, but not the completion of the pattern. The completion of the pattern will happen in another 6 months afterwards at a lower high, and then you get the big bear market drop. But I'm 80% happen. 80% confident we get that new high third quarter, fourth quarter this year. and then I think it's going to get very interesting.
Yeah, amazing. Love it, mate. Could chat for a lot longer, but
You
we'll
want to
let you
quickly catch on fashion or sports for a second or two?
Yeah, give us a couple of minute overview on that.
Yep. So people are wondering why, what that's got to do with investing, but it's all related to sentiment. A hardcore Elliott Wave guy will tell you news has absolutely no impact on the market, and that causality is actually the reverse. It's sentiment that creates the news, and that's why you get this buy the rumor, sell the fact. That shifts in psychology are reflected in real time and prices, and only later do you see actual events happen. But because it's already reflected in the market, you get buy the rumor, sell the fact. So they're always looking for changes in sentiment, not just affecting the market, but other arenas as well. Sports is a big one. Bull market sports are basketball, baseball, non-violent type sports. MMA, boxing, they do very well during bear markets. Because people are more angry, they're losing money, that kind of thing. So they tend to gravitate towards more violent type stuff. And in fashion, it's funny, my joke is if you want to know what the economy is going to do, don't ask an economist, ask a fashion designer, because, their profits relates to the design of the clothes they'll come out with months from now. So, if a well-known fashion designer is designing a wardrobe of a lot of black clothes, that's the kiss of death for stocks. Probably 3-4 months from now, the market's going down because black is a bear market color. And it's same with music as well. At tops in the markets, pop music is very popular. Bear market, it tends to be more grunge music. You can look at clothes, the hemline index, the length of the skirt. During bear markets, people are more females are more conservative, and going into major tops like 2000, that skirt gets shorter and shorter and shorter. Kind of thing. So the trends that happen in the market are reflected in the whole economy. I'm
not sure about that, mate, because I wear budgie smugglers 24/7, no matter the market. So
that's the that's the over here. I know I can't get around to it. I still wear my board shorts.
It's very interesting. It sounds a bit wacky, but you've sent me a few links which I'll put up as well that kind of back some of this stuff with data and science. So it's quite interesting. But mate, we'll let you go. I really appreciate you coming on, Brendo, Bo, Westy. Have you got any parting questions for Dan at all?
No, mate, thanks for coming on, Bart. It was really interesting. It's good stuff.
Yep, no worries. Look, I'm happy to field. If you guys have questions, you can send them through to me directly or through Armado. No problems, because I love this stuff. I'm on fire. It's 1:40 in the morning. I've been up for 22 hours this morning, and I can't shut up. I still got so much more to say, but yeah, I've got to let you guys go. You're trading the market. I've got a newsletter to write sometime today, so yeah. And a valley to hike. I want to go out there for a big hike today if the weather's good.
Beautiful. Yeah. Brendo, have you got anything for Dan?
No, thanks, mate. Thanks, really. It was, I love the way you think. It certainly opened my mind up to a few different sort of things. I would like to do something with that lunar cycle thing, put it into a chart, and just going forward, just have it in the back of my mind. Thanks. Thanks.
I reckon Bo's probably ahead of you there, Brendo. I reckon he's already pulling up charts on it, and
with the lunar phases, they work really well around the equinoxes, not as well around the solstices. So just keep that in mind that not all full moons are created equally, but around the equinoxes, they're really something to pay attention to.
Mm-hmm.
Yeah, got it.
Awesome.
Well,
all right.
I'm going to chat again at some point, Daniel, but that was great.
Oh, for sure. 100%. This is my passion. This is my passion in life. I could just ramble on for days if you let me.
Great. No, it was an amazing chat, mate. Thank you so much for coming on. And yeah, definitely keen to to have a yarn another time, maybe at a better time for you. But yeah, thanks, mate. Really appreciate it.
Yep, no worries at all. Yeah, I'm glad you guys invited me along. Like, I love this stuff. So,
All right, cheers, buddy.
yep. All right. Ciao, ciao.
Cool.